Hi everyone, this short video will explain the notion of adjusting entries. Adjusting entries is the fourth step in the accounting cycle and occurs at the end of each accounting period. After the trial balance is prepared, adjusting entries are required in accounting because of accrual basis of accounting. There are two accounting methods that ensures revenues are recorded, cash basis and accrual basis of accounting. Our main focus today is on accrual basis of accounting, which suggests that revenue recorded when earned and expenses are recorded when incurred. There are four situations in which adjusting entries occur. First off, deferred revenue. During the period, customers pay in advance of receiving any benefits, such as receiving a product or service in the future. The business therefore has to record a liability because they owe their customers in the future a product or service. Therefore, the liabilities must be adjusted to reflect that revenue has now been earned and the liability has been settled. The general rule for accrued revenue is when a company earns a revenue before it receives cash, the company should increase a receivable account, which is an asset, and a revenue account for the amount earned. For example, a joinery business agrees to complete one of the service for a new client for $1,000 and the client will pay later. The journal entry would look like this: debit your accounts receivable and credit service revenue. Once payment has been collected, the journal will then look like this: debit cash and credit accounts receivable. Deferred expense is when a business pays first before they incur an expense. During any period, businesses purchase assets which have future economic benefit. Supplies and equipment are examples of assets that will be used by any company. Assets must be adjusted to reflect the reduction in value based on its use. At the end of a period, the business may have consumed a good or a service which they have not yet paid for. For instance, paying employees wages. Employees will complete their duties for the business. However, during this time, the business has incurred an expense. This is referred to as an accrued expense or accrued liability adjusting entries. This wraps up today's screencast with one more example for my makeup fanatics. So, Kylie Cosmetics purchased supplies at a cost of $12,215 during 2014. Now, the question is, what adjusting entry is prepared at 31st of December 2014? So, as illustrated in the previous slides with the information and the 3 dot points here, we understood that the supplies used, we total them up and then we minus the ending balance gives us 14,000, meaning we have to debit our supplies expense and credit our supplies. And thank you so much for listening.